In this presentation, we will take a look at multiple choice questions related to CVP analysis or cost volume profit analysis, going through the questions and then practicing test taking skills with them. First question, expected sales over the sales level at the break-even point. A, unexpected sales. B, profit margin. C, contribution margin. D, net income. Or E, margin of safety. Let's read that again and go through the process of elimination. Expected sales over the sales level at the break-even point. A, unexpected sales. So we would think that they wouldn't all be unexpected. We wouldn't think if there's any sales over the break-even point, we would expect that to happen. Hopefully, they are expected, but they're over the break-even point. That's the point at which we at least are making a profit. The break-even point meaning we don't have profit or loss. Anything over that is a profit. So I would think they would be hopefully expected. And then B, the profit margin. That term might sound actually reasonable term to have because if it's over the break-even point, you would think that would be the profit. So I'll keep that for now. And C says contribution margin. So again, that's another term that should be familiar in CVP. So we're going to say cost volume profit contribution margin. I'll keep that. D says net income. Now, net income is going to be the bottom line number. We're talking about sales or revenue, the top line number, net income, bottom line number. So it doesn't think it's going to be D. And then E says the margin of safety. And that's another term that sounds familiar. So we'll keep that for now. We'll keep B, C, and E and see what else we have. We'll go through this again. Expected sales over the sales level at the break-even point. B, profit margin. C, contribution margin. E, margin of safety. So this is the sales, because we can calculate the sales at the break-even point. In other words, the sales we need to not have a gain or a loss. And then we're talking about any sales above that. And we typically name that the margin of safety. So the sales above that break-even point, we typically call the margin of safety. So final answer, expected sales over the sales level at the break-even point. E, margin of safety. Next question. Unit contribution margin is A, sales price per unit less cost of goods sold per unit. B, sales price per unit less fixed cost per unit. C, sales price per unit less total variable cost per unit. D, sales price per unit less unit total cost per unit. E, not a thing. Okay, so let's go through this again and we'll use the process of elimination. Unit contribution margin. So remember that when we talk about the contribution margin, we often think about it in total or in units. So now we got the unit contribution margin. A, sales price per unit less the cost of goods sold per unit. So I'll keep that for now because that probably sounds kind of familiar. So we'll keep that for now. B says sales price per unit less unit fixed cost per unit. Less unit fixed cost per unit. So the sales price minus the fixed cost. And that's a little bit backwards because usually the fixed cost per unit is a kind of an average because the fixed cost stays the same no matter how many units we have. So usually we think about the sales, which changes with the level of production, and the variable costs, not really the fixed cost. So it doesn't seem like B. C says sales price per unit less variable cost per unit. Those are the two we can compare usually because they act the same. Sales acts and changes in a similar fashion as variable cost. So I'm going to keep that one. I didn't mean to cross it out. I'm going to keep that one for now. D says sales price per unit less unit total costs per unit. So the sales price as compared to the total cost, maybe. I'll keep that. And E says not a thing, which doesn't sound reasonable. So we'll have A, C, and D. Let's go through this again. Unit contribution margin is either A, sales price per unit less cost of goods sold per unit. C, sales price per unit less total variable cost per unit. D, sales price per unit less unit total cost per unit. Okay, so of these three, A sounds reasonable, probably most familiar because it's a financial accounting term. And cost of goods sold, note, isn't what we typically use in the cost volume profit. That's going to be a financial accounting term. That would be basically gross profit per unit is what we're considering here. But this is CVP. We're breaking things out by behavior, fixed and variable. And then C sounds reasonable because sales price per unit and total variable costs sound reasonable versus D says sales price per unit and total cost. Total cost meaning variable and fixed. We can't really compare that as easily because they don't act the same. So really the contribution margin is C here. That's what the comparison we typically make. That's why we break out between fixed and variable. We can compare the sales to the variable costs. Final answer. Unit contribution margin is C, sales price per unit less total variable cost per unit. Next question. Contribution margin ratio, A, is the percent of each sales dollar that remains after deducting the total unit variable costs. B is the percent of each sales dollar that remains after deducting unit fixed costs. C is the percent of each sales dollar that remains after paying the rent. D is not useful. E is not income over sales, is net income over sales. Okay, let's go through this again using the process of elimination. Contribution margin ratio. Now, even if we don't really know the contribution margin ratio, or we don't feel like we have a grasp, it's a ratio, we might not, we know what the contribution margin contains. It's going to be the sales minus the variable costs. And then we have a ratio that has something to do with sales and variable costs. Okay, so then A says, is the percentage of each sales dollar, so sales dollar, that's part of it, that remains after deducting the total unit variable costs. So that at least includes things on sales and variable costs, so that seems reasonable. I'll keep that for now. B says, is the percentage of each sales dollar, so sales dollar, that remains after deducting unit fixed costs. Now, that's not usually involved in the contribution margin. We're not usually talking about fixed costs. We're talking about the things that vary with production level. So it's not usually B. C says, is the percentage of each sales dollar, that's one of the factors, that remains after paying the rent. Now, the rent's a fixed cost, and it's very specific. So that doesn't seem like it's going to be right for those two reasons. And D says, is not useful. And it sounds like a very familiar term, and the book's promoting it, so I would think that they would disagree with that. So, and then E says, is not income over sale, is net income over sales. So net income over sales kind of sounds like if that's a ratio, that's a ratio analysis. So let's keep that for now. You'll note that, well, let's read through it again. Contribution margin ratio is either A, is the percent of each sales dollar that remains after deducting total unit variable costs, or E is net income over sales. Now, the next thing we might want to consider just from a test-taking skill point is that A, B, and C are very similar in language. So there's only one thing that there's a few different things, words that change the answers between those. That sometimes is an indication that one of those might be the answer because they sound very similar. They're just tweaking one word. Maybe it's one of those answers for that reason. So for that reason, I would give more weight to A than E. E, net income over sales, is like the bottom line number over sales, and a vertical analysis type of calculation, but we're concentrating here on like the contribution margin, which usually just isn't the bottom line number, isn't net income. It's going to be the contribution margin, which we said was the sales minus the variable cost. So A seems most appropriate here. Final answer, contribution margin ratio A is the percent of each sales dollar that remains after deducting the total unit variable costs.